Welcome to today's Explainer, folks. I'm Steve. Listen, you're going to want to keep your risk management locked absolutely tight right now because we are watching a brutal, high-stakes game of chicken playing out on the tape. I mean, institutional capital is aggressively repositioning itself right before the morning bell. They're bracing for the primary macro event of the entire week. Yeah, we're talking about the May Consumer Price Index report.
4.2%. That's the consensus forecast we're staring down. They're predicting headline inflation to hold steady at a really hot 4.2% year over year. And that heat, well, it's fueled by the energy premium just bleeding straight through logistics and wholesale chains. But here is the absolute danger of our current setup. The Federal Reserve is locked, and I mean completely locked, in its official pre-meeting blackout window ahead of next week's June FOMC decision. What does that mean for us? It means policymakers literally cannot step to a microphone to intervene or manage market expectations. So if tomorrow's print surprises to the upside, you can expect an immediate automated sell-off across the board as computers instantly price in higher interest rates.
Now, the mainstream financial networks, they're going to try and distract you with corporate hype and talking heads. Forget them. On this desk, we have one rule. We track structural flows and we ignore retail noise. Period. So we're opening the ledger today to see exactly where the real power sits, completely bypassing all that fluff. Let's jump right into the pre-data flush. Looking at the board, S&P 500 futures, the E-mini contract, has been absorbing some incredibly heavy selling pressure. Large-scale managers are just clearing out their risk, grinding things right down to settle at 7,364. And digital assets, they're actually leading this risk-off flight. Bitcoin is facing steady intraday distribution, dropping over 2% down to $61,979. But listen, what you're seeing here isn't a panic. It's really not. It's automated desks aggressively pulling back leverage. They are actively reducing their borrowed risk right before the data hits.
Now let's talk about the tech sector correction that's currently unfolding.
See, for months, the market just relentlessly bid up AI and mega-cap software operators on pure earnings power. The retail illusion was that these tech margins were somehow completely insulated from macro pressures. Obviously, that's not the case. Right now, this massive AI rally has hit a rock-hard roadblock. Ahead of this major red folder print, big institutional money is looking at these wildly overextended valuations and, well, they're simply doing the math. They realize that if interest rates stay high, the massive price tags on these tech stocks just can't be justified. What we are witnessing is a structural reset. Big tech is losing its risk-free premium, and that directly impacts the core holdings in pretty much every standard portfolio out there.
Moving over to the core gold battleground.
At $4,293.40, spot gold is fighting a gritty, low-volume war, trapped right underneath its 200-day simple moving average. The long-term trend lines are just entirely tangled up right here. This technical breakdown, it tells us that institutional funds are treating gold as a source of cash. Why is that? Well, because the bond market is fully anticipating a highly restrictive Fed for the rest of 2026. If gold can't reclaim its moving averages after the CPI print, that technical floor drops significantly lower. And that is a massive signal showing exactly how large funds are choosing to hoard liquidity instead of holding assets.
Next up is the energy curve disconnect, which is absolutely fascinating.
Out in the cash market, spot Brent crude is whipping around wildly based on shipping frictions in the Gulf. But our active July 26 contract, that's the BZN 26, closed completely unchanged. It is pinned right to its technical anchor at 91.89. The paper market is flat out refusing to validate these short-term spot spikes. Seaborne commercial arrivals are hitting multi-year lows, and that shows us that long-term energy headwinds are being heavily suppressed by global demand limits. This is a critical release valve for corporate input costs, and honestly, it is ignoring the noisy news headlines entirely.
All right, let's lay down some professional trading directives.
We need to talk about the algorithmic wash we're dealing with, where computers violently flush out the weak positions. Just look at the tape action. An aggressive intraday drop taking us from the 7400s all the way down to that low of 7247, pushing well below average price bands before just violently snapping back up towards 7390. This kind of volatility is exactly why you have to stay disciplined. Our core structural anchor going into tomorrow remains the 50-day moving average. That trend line, that is your absolute line in the sand. If the E-mini drops on a hot inflation print and fails to defend that moving average on a weekly closing basis, well, the primary bull engine is officially compromised. So here is your tactical blueprint. Rule 1, stop guessing the direction of the print. Seriously, let the hard data dictate your risk. Rule 2, watch the 50-day moving average like a hawk. And Rule 3, wait for the wash. Do not touch a single button until that initial, violent, algorithmic clearing out of weak hands is completely finished.
But listen,
we also have to be ready for the massive, coiled opportunity on the other side. If inflation actually cools tomorrow and our crude contract drops below that $91 shelf, the macro release valve opens wide up. If that happens, you need to be prepared for a massive equity relief rally ripping straight back toward old highs. This is exactly where your patience pays off.
The ledger is coiled incredibly tight. The flows are set. Tighten your stops, manage your position sizing, and trust the structural data, not the network noise. So, are you ready for the morning bell? Stay disciplined out there, and I'll see you on the tape.